Hey everyone, welcome back to Delta Edge, your ultimate destination for all things stock market. Today, we're diving into the top mistakes new investors make and how to avoid them. And guess what? If you watch this video till the end, you could get a surprise worth 21,000 rupees. Stay tuned for details. Investing in the stock market can be incredibly rewarding, but it's also easy to make mistakes, especially if you're new. Today, we'll cover the top mistakes new investors make and how to avoid them. We'll use real-time examples from Nifty 50 stocks and combine both technical and fundamental analysis. Let's get started. With the right knowledge and strategies, you can navigate the stock market with confidence and minimize risks. So, whether you're a newbie or just looking to brush up on your investment skills, this video is for you. Hit that like button and let's dive in. Investing in the stock market can be incredibly rewarding, but it's also easy to make mistakes, especially if you're new. Today, we'll cover the top mistakes new investors make and how to avoid them. We'll use real-time examples from Nifty 50 stocks and combine both technical and fundamental analysis. Let's get started. When you first enter the world of investing, it's easy to get overwhelmed by the sheer volume of information out there. The stock market is a complex system with many moving parts, and without proper guidance, you can quickly find yourself making costly errors. But don't worry, because we're here to help you navigate these waters. The first step to becoming a successful investor is to understand the common pitfalls that many new investors fall into. By identifying these mistakes early on, you can avoid them and set yourself up for long-term success. So, let's dive into the top mistakes new investors make and how you can steer clear of them. The first mistake is not doing enough research. Successful investing requires understanding the market, the stocks, and the companies you're investing in. Many new investors jump into the market without taking the time to thoroughly research their investments, leading to poor decision-making and potential losses. Researching a stock involves looking at the company's financial statements, understanding its business model, and analyzing its competitive position in the market. It's also important to stay updated with the latest news and trends that could impact the stock's performance. Without proper research, you're essentially gambling with your money. It's crucial to have a solid understanding of what you're investing in and why. This will help you make informed decisions and avoid unnecessary risks. Remember, knowledge is power. The more you know about your investments, the better equipped you'll be to navigate the stock market successfully. So, take the time to do your homework and make informed investment choices. Mistake number 2 is emotional trading. Letting fear or greed drive your decisions can lead to significant losses. The stock market is inherently volatile, and it's easy to get caught up in the emotional highs and lows. However, making investment decisions based on emotions rather than logic and analysis can be detrimental to your portfolio. Fear often leads investors to sell their stocks prematurely, especially during market downturns. On the other hand, greed can cause investors to hold on to their stocks for too long, hoping for higher returns only to see their gains evaporate. It's important to stay calm and rational, even in the face of market fluctuations. One way to avoid emotional trading is to have a well-defined investment strategy and stick to it. This includes setting clear investment goals, determining your risk tolerance, and having a plan for when to buy and sell stocks. By following a disciplined approach, you can make more rational decisions and avoid the pitfalls of emotional trading. Overtrading is another common mistake. Trying to capitalize on every market movement can result in high transaction costs and potential losses. Many new investors fall into the trap of constantly buying and selling stocks, thinking that they can outsmart the market. However, this approach often leads to poor performance and increased trading fees. Overtrading can also lead to burnout and stress, as you're constantly monitoring the market and making quick decisions. It's important to remember that successful investing is about long-term growth, not short-term gains. Instead of trying to time the market, focus on building a diversified portfolio of quality stocks that you can hold for the long term. By adopting a more patient and disciplined approach, you can reduce the impact of transaction costs and increase your chances of achieving your investment goals. Remember, sometimes the best action is no action at all. Let your investments grow over time and avoid the temptation to overtrade. Chapter 5. Mistake number 4 is ignoring stop-loss orders. Stop-loss orders help protect your investments by limiting potential losses. A stop-loss order is a predetermined price at which you will sell a stock to prevent further losses. It's a valuable tool for managing risk, especially in a volatile market. Many new investors overlook the importance of stop-loss orders, thinking that they can manually monitor their investments and make timely decisions. However, the stock market can move quickly, and emotions can cloud your judgment. By setting stop-loss orders, you can automate your risk management and ensure that you don't lose more than you can afford. It's important to set stop-loss orders at a level that allows for normal market fluctuations while protecting your investment from significant losses. This requires careful analysis and a clear understanding of your risk tolerance. By incorporating stop-loss orders into your investment strategy, you can safeguard your portfolio and minimize potential losses. Chapter 6. The final mistake is lack of diversification. Putting all your money into one stock increases risk. Diversify your portfolio to manage risk effectively. Diversification involves spreading your investments across different asset classes, sectors, and geographical regions to reduce the impact of any single investment's poor performance. Many new investors make the mistake of concentrating their investments in a few stocks, thinking that they can maximize their returns. However, this approach can backfire if those stocks underperform. By diversifying your portfolio, you can mitigate risk and increase the likelihood of achieving consistent returns. A well-diversified portfolio includes a mix of stocks, bonds, and other assets that align with your investment goals and risk tolerance. It's important to regularly review and rebalance your portfolio to ensure that it remains diversified and aligned with your financial objectives. By diversifying your investments, you can build a more resilient and stable portfolio. Chapter 7. Let's look at some real-time data from today's market to identify current trends and opportunities. By analyzing live market data, we can gain valuable insights into the performance of various stocks and sectors. This will help us make informed investment decisions and identify potential opportunities for growth. First, let's take a look at the Nifty 50 index. The Nifty 50 is a benchmark index that represents the performance of the top 50 companies listed on the National Stock Exchange of India. By analyzing the trends and movements of the Nifty 50, we can get a sense of the overall market sentiment and identify potential investment opportunities. Next, we'll drill down into specific stocks and sectors that are showing strong performance. By using technical and fundamental analysis, we can identify stocks that are poised for growth and make informed investment decisions. We'll also look at any recent news or events that could impact the market and adjust our strategy accordingly. By staying updated with real-time market data and trends, we can make more informed investment decisions and maximize our returns. Remember, the stock market is constantly evolving, and staying informed is key to successful investing. Thank you for joining us on this journey to becoming a better investor. Remember, avoiding common mistakes and staying informed are key to achieving your financial goals. We hope you found this video helpful and look forward to bringing you more valuable content in the future. Happy investing!